Can you guys hear me? We had some technical difficulties. Are we on now? Anybody with me? All right, I've got some people on here. I just wanted to make sure. We had some serious problems. Sorry, guys. First time. Not very polished at this. Maybe last time. Welcome to the first ever Barfield Financial question and answer. Maybe last. We'll see how this all works out. I'm just looking at the chat. I see your comments. Cool. People can hear me. Let me know how the audio is, if it's good, clear, whatever. Coming at you live from world headquarters of Barfield Financial. In the background, you can see the coin wall that many of y'all have helped build. There's a few hundred coins up there. Let me try to give you a better shot. Just a ton that you guys have sent, dozens of agencies, hundreds of coins up there. So thank you guys for that. I have asked and you guys answered. You submitted hundreds of questions about different FERS questions, TSP, all kinds of different things like that. So we're going to get to those. By far, the vast majority, 90-something% of these questions revolved around TSP, and particularly moving money from TSP to an IRA and back again. So we're going to discuss a lot of that. I think I could probably answer 50 or 60 of those questions with just kind of an in-depth talk about how the transfers are made. Secondly, what just kind of shocked me, but a lot of you guys ask questions about Medicare. That's unusual. I don't get a ton of questions about Medicare, but that was by far the runner-up in the list of questions you guys submitted. So we will talk about Medicare, how it works with FEHB, how all that kind of stuff. It seems like it's complicated on the surface. I'm going to oversimplify that, so it'd be no issues whatsoever. If you guys have questions, put them in the chat. What we'll do is I'll answer those two big questions. Then I have a list of a bunch of random things that people sent me. You know, how would I invest a couple $100,000 if I was given it? You know, what my favorite ice cream is. I mean, just whatever. I'm going to answer all those questions that you guys, well, not all of them probably. And then at the end, anybody that's still with me that I haven't put to sleep yet, you guys, I'll take your questions and we will just, go for an hour, hour and a half. If for some reason, you're like, this sucks and you leave, doesn't hurt my feelings. This will be archived. You guys can watch this at any time in the future. Okay. So, you'll be able to rewind this because I'm going to talk about some concepts that might be a little bit like, man, I want to hear that a couple of times before I understand it. Don't worry. It's not your one shot to get all this information. You can come back and watch it whenever. Whether or not I continue to do this is going to rely heavily on the comments that you guys give me and the feedback. So again, if it sucks, just let me know. If you think it's fantastic and maybe this becomes a regular scheduled thing, just let me know, whatever. I'm here to answer questions for you guys. Before we get into that, there are probably some people on that really don't know that much about me. Maybe you just came to the channel recently or to my website recently. So let me give you a little background on me and kind of how I came to do this stuff. I was under FERS for 24 years. I was a Deputy U.S. Marshal, Job Series 1811 for those of you, that's law enforcement basically. So I did that for 24 years. I retired in October of 2022, almost not quite 2 years yet. Prior to that, I was a police officer in Charlotte, North Carolina, which is where I'm from. That is pretty much my career in a nutshell. Nothing super exciting. I did, pretty much what everybody else did. I started my career in Puerto Rico and spent the rest of it in Indianapolis, which is where I live now, on the north side. But, nothing super special. None of that really explains why I'm teaching or talking about retirement. So how did I come to that? All of my formal education, I spent my adult life in law enforcement, but my formal education has all been in accounting. I have a bachelor's in accounting, I have a master's, I'm a CPA. So that was always like a parallel track that I was always on. I kind of kept with that because I've always liked numbers and finance and the market and stuff like that. One day when I was at work, just counting the ceiling tiles again, about 6 or 7 years before I retired, this thought popped into my head that eventually led to where I am right now. And it was simply this: what do we get for all of this? For putting up with the government, for giving the government the best years of our lives for 20 or 30 years, what do we get in return? When it all ends, what are we left with? And I had this vague notion, probably like a lot of you, we get some kind of pension. I know we had the TSP. I could check my balance. I know I got that. But when was I eligible to actually use that? Were there penalties? Is it taxed? Can I do whatever I want to with it? Do I have to wait a certain period of time? All those questions. And I did like what most people do. I started asking my coworkers, and quickly that became disconcerting because I work with law enforcement. Law enforcement, we will not say, I don't know. We will give you an answer. And so I got answer after answer. Unfortunately, no two answers matched. And so after talking to 10 people and getting 10 different answers, I was a little bit anxious. And I'm like, well, what does happen at the end of all this? Maybe this is the biggest scam in the world, So I said, the heck with all that. I'm not asking anybody else. I'm going to go research this myself. I'm going to learn it. I used all that accounting. I was comfortable. I'm comfortable reading tax law and government regulations, FERS, OPM stuff, TSP, Social Security, whatever. So I became obsessed, and I mean obsessed. For months, I studied this. That's all I did at work. I filled up legal pad after legal pad. I had whiteboards on the wall. This became my, vocation, so to speak. I mean, literally, this was all I did. It was, serial killer, beautiful mind type stuff in the office, just plastered all over the walls. Eventually, I started summarizing those things into what was called at that time, you guys called it that. You guys called it white papers. I would write an article about the supplement. How does this supplement work that we get? This FERS supplement. What is it? What is it? How much is it? When do we get it? And then I'd take another topic and I'd write sick leave. Do we get credit for sick leave? If so, how do we get credit for sick leave? All of those kinds of things. How does the annual leave lump sum payout? How does that work? Do we get taxed? How much is the tax? When do we get it? What rate is it? All of those things. So I'd write an article about each one. And it was really more for selfish reasons. I just really wanted to understand our retirement. I was so naive in the beginning. I just didn't know anything about this. I would even send emails to HR asking them to explain our retirement system. And for you that have dealt with HR, you know how hilarious that is, that I expected a personal response from somebody in HR explaining our retirement system to me. So I quickly realized we aren't in the private sector. We don't have people that walk us through that sort of thing. So I did it on my own. I started helping some other people. Those white papers eventually got sent out sort of as like a monthly newsletter. In the beginning, it wasn't really a newsletter. It was just an email to 4 other people in the courthouse. But it grew over time, and now I still have the newsletter. Still goes out. Probably many of you that are watching this are subscribers. It goes out. There's about 20,000 or so people a month that read it, and it grows by a couple hundred people a month now. So that is what led to me speaking at retirement seminars for all kinds of different agencies, FBI, DEA, marshals, the courts. I've got one next week for DEA. I do a lot for them every few weeks. I've got the Nuclear Regulatory Commission coming up next month. Bunch of different agencies. Some of them I didn't even know existed or what they did before I started this. So that has led to a lot more exposure into this sort of thing and trying to help people. This has become my retirement mission job. Okay. It's sort of a lie to say that I'm retired because I answer questions from you Furzonians all day, every day, even late into the night. Sometimes I just gotta take a break from it. But anyway, that's why we're here. Enough about me. We got some stuff in the chat. Cool. Let's talk about TSP. So Thrift Savings Plan. It's the government's version of a 401k. It's the retirement plan. It's the largest one in the world. There's about $800 billion in there. Hopefully everyone watching this, almost 200 people, has a lot of money in TSP or is on their way to having a lot of money in their TSP. Well, we'll talk about that. Once you retire, we could talk about TSP for like literally days, and I do in retirement seminars. So if you're interested in TSP workshops and stuff, have your agency hire me and we'll talk all about TSP. But one of the options that you're going to have, and this is what a lot of questions were about, so I'm going to address this first. Once you retire, you leave the government, you have an option to move your TSP, to transfer it, what's called a rollover, to a private IRA. So if you don't know exactly what an IRA is, it stands for Individual Retirement Arrangement. A lot of times people say account, but it's basically a private retirement fund. The TSP, in contrast, is what's called an employer retirement plan. You go through your employer. Many of you may have worked at a company that had a 401k or a 403b. Those are employer plans. You put your money in that plan through your employer. You can also do a very similar thing in the private sector. Rules are a little bit different, but that's an IRA, but it's still a retirement account. It still has the tax benefits of like the TSP, which we'll explain in a second. So when you retire, you can move your money from the TSP to an IRA. I'll explain the mechanics of it in a second, but first of all, this was a lot of questions I got. Why would somebody do this? Okay, what's the purpose about that? So let's talk about why somebody would do it, some of the advantages and disadvantages first, and then we'll talk about exactly how to do it. So why would somebody move their money from the TSP to an IRA? Well, first of all, no one ever has to do this. Okay, so don't feel like you have to do this. This is not a requirement whatsoever. You can leave your money in the TSP for the rest of your life. That is by far the simplest thing to do. The money just stays there. You withdraw it whenever you need to or want to, and you don't ever have to worry about any of the stuff that we're going to talk about. But there are a lot of people, and judging from the statistics, there's an increasing larger amount of people that are wanting to do this, move their money into an IRA. What are some of the advantages? Why would somebody do that? Well, number one, in an IRA, you are not limited by investment choices. In the TSP, you have 5 funds. You have the G, F, C, S, and I. That's it. Those are the only funds that you have, the only investments that you have inside the TSP. You do have the option now to go out and buy some mutual funds out in the private sector. No one does that, but there is that option, but we're not going to talk about that. Those aren't TSP funds per se. The only TSP investments are those 5, G, F, C, S, and I. If you have an L fund, that is not a different investment. That is simply the combination of those 5 funds. That's it. I don't care if you're in the L income, the L 2030, the L 2060. Only thing that you invest in those L funds are those 5 TSP funds. That's it. Every single one of them has those 5 and nothing else. In contrast, if you move your money over to an IRA, the whole world is open to you. You can buy individual stocks. You can buy thousands of individual stocks. You can buy thousands of mutual funds. You can buy individual bonds. You can buy, there's ways that you can set up IRAs where you can buy gold and silver or even real estate. You could trade options. You could do anything. There are literally tens of thousands of investment choices available to you. Some people like that. People that want to trade and want to be very active in managing their money, they are going to naturally prefer an IRA over the TSP. TSP is perfectly fine. People grow $1 million, $2 million, $3 million in TSP. It's perfectly fine. Those investments are okay. And frankly, all those investments are also available in the private sector with the exception of the G fund. Everything else is available in the private sector. So number one is people move their money over because they want more investment options. Number two, I'll just wrap this up in saying that it is better customer service. Okay. If you have an IRA at a brokerage account, and you set these up pretty much anywhere you want to set them up. So Charles Schwab, Fidelity, Vanguard, Edward Jones, Raymond James, Merrill Lynch, all of these different places, you can set up an IRA at any of those. The tools and the ease of use and the advice and help that you're going to get far exceeds what you're going to get through the TSP. Some of you may have an account at Charles Schwab, for example. I do. I've had one since I was 17. You can have all kinds of research tools. You can do all kinds of investment planning. There's calculators. You can call and talk to people that will give you advice if you want. There's all kinds of things that you can do inside your IRA that you can't in the TSP. The TSP has gotten better, but it's still far short of what you're going to see in the private sector. You may call somebody in TSP and you may get somebody that doesn't have any idea what you're talking about in investments. They should, but not all of them do. That's going to be very rare if you call somebody at Fidelity to help you. If you call your broker, they have to obviously have certain license and continuing education and requirements. And it's just, let's face it, it's easier to get fired in the private sector if you're incompetent. So, if you don't do a good job or you upset people or you're rude or whatever, you're not going to have a long life expectancy at one of those firms. Okay. So better service, better customer service, that sort of thing in an IRA compared to the TSP. Thirdly, withdrawal options. This is an area where the TSP has gotten better. But in an IRA, you have really no withdrawal restrictions. In the TSP, let me explain it this way first. The TSP, you can pull out a monthly amount. You can set up a withdrawal that just automatically comes every month. Or in addition to that, you can do one-time withdrawals. You can just pull money out. Used to be you could only do it every 30 days, once every 30 days. That changed just last month. So that is actually getting better. It's a little more flexible. Used to be years ago, you could only do one partial withdrawal in your lifetime, and then the rest had to be a series of payments. It was very restrictive. That, luckily, fortunately for us, has gone away. But you can do one-time withdrawals from TSP, but it has to be a minimum of $1,000. You don't have that in an IRA. You can pull money out whenever you want in any amount, most cases. There is another weird little quirk about TSP. If you want your money, you have to get your spouse's permission. It's your money, but if you put in for a withdrawal from the TSP, they're going to send an email to your spouse and say, hey, Chris is trying to pull out some money. Do you authorize this withdrawal? And if they say no, the money's not coming out. So some people don't like that. That obviously does not exist in the real world. That is not at Schwab or Fidelity or whatever. You want your money, you can pull your money out. You don't need to get permission from anyone. So withdrawal options are still in the pro column for IRA compared to TSP. This is probably the big one. And this is the thing where I think the TSP is really falling short. And I wish that they would me and most everybody else wish If you have, let's just use C and G right now to keep the example simple. You have your TSP account, you have money in the C fund, and you have money in the G fund. And if you've had money in the C fund in the last 18 months, you've made almost 50% on your money. Okay. My TSP has gone up a couple $100,000 since I retired from the C fund. It's been doing great. Up 25% last year, almost up 20% this year. It's fantastic. So let's say you're looking at your TSP account and you've got your G fund, which is basically a savings account, a high yield savings account. And you've got your C fund, which is killing it. And the C fund has made a ton of money. And you want to pull out $50,000 to go buy a car. And you're like, you know what? I want to pull that money out of the gains. I don't want to touch my savings account, my G fund. I just want to sell some of my C fund and take that money. The TSP will not allow you to do that. That is not allowed. They will send you, regardless of where you want that money to come from, it doesn't matter to them. They're going to send it proportionally to you across all of your funds. So if you were, in this example, let's say 70% C and 30% G, and you want $1,000, they're going to send you $700 from your C and $300 from your G. That makes absolutely no sense. No one wants that. We want to be able to control where we pull our money from. Conversely, think about this. Let's say that the C fund is down a lot. Let's say it's lost a couple $100,000. Now you don't want to pull money from your C fund. You want to pull money just from your G fund, your savings account. It hasn't gone down. It's guaranteed not to lose money. So you want to pull some money from that. You don't want to sell your C fund at a loss, right? You don't want to lock in those losses. You want to let that recover over time. Doesn't matter. Doesn't matter. TSP is going to send you that check proportionally across both of those funds. People do not like that. In a recent survey, 89% of TSP respondents said, we want the ability to pull from whatever fund we want, whatever investment we want. So that is a huge reason for going to an IRA. Obviously, that rule does not exist in an IRA. If you've got Tesla stock and Apple stock and a mutual fund, you can decide whatever it is you want to sell to withdraw the money from. TSP does not allow you to do that. Okay. So those are huge advantages for the IRA. Those things. The last thing I'll talk about is the fees. Fees are cheaper. This might shock some people. You might argue with me at first because of what you've heard over and over the years. The fees are cheaper in the private sector than they are in TSP. TSP fees are more expensive if you're comparing investments to investments than the private sector. If you're looking at the expense ratio of your C fund, it's like 0.05%, whatever. The same C fund at Fidelity, which is an S&P 500 index fund, it's the exact same fund. The same fund at Fidelity is 0.015, basically a third, less than a third of the cost of what you're going to pay through TSP. Okay. And that is true for multiple companies, Schwab, Vanguard, Fidelity. All of the fees that they have are cheaper than the TSP fees. Okay. I know there's this long-standing concept that we don't move money out of TSP because the fees are so cheap. You can look this up. TSP fees are more expensive than private sector index funds. If you're comparing an investment to the same investment, it will be cheaper in the private sector. Okay, so those 5 things are why the IRAs are better than the TSP. So you could move your money out into the IRAs for one of those reasons. You know, better or more investments, better withdrawal options, better customer service, lower fees, and more control over your account. Sell what you want. With that being said, is there any advantage to the TSP? Yes, there is a huge advantage to the TSP. As a general rule, in all retirement accounts across the board, IRAs, 401ks, TSP, whatever, as a general rule, if you pull money out prior to being 59 and a half years of age, Weird rule, right? Like nobody in the government could pick 59 or 60. Somebody had to settle on 59 and a half. If you pull your money out before 59 and a half, you generally have to pay a 10% early withdrawal penalty. That's called an early withdrawal. Your retirement funds are not just available for you whenever you want them. There are restrictions associated with them. One of them is you have to be 59 and a half. There is a huge exception inside the TSP. Okay, there are two categories of people listening to me right now. One category is special, what's called special category. I'm not saying that you're special. That's OPM. You're a special category. That is law enforcement, firefighters, air traffic controllers. That is a special category of FERS. You guys, I'm in that category. We can get our money from the TSP whenever we retire. It does not matter the age. Used to be 50. That rule is gone. It's at any age. My wife retired from the FBI at 49. She could pull money out of TSP immediately without paying the 10% penalty. Okay, so special category, you can pull your money out anytime you retire without paying the extra 10% early withdrawal tax. If you transfer your money over to an IRA, I don't care that you were law enforcement or fire, and the IRA doesn't care either. Now you have to wait till you're 59 and a half to pull that money out. If you leave it in the TSP and you pull it out directly from the TSP, you withdraw it, you pull it to your bank account, you don't have to pay the extra 10%. You do if you transfer it to an IRA and you pull it out prior to 59 and a half. Okay, so that's advantage TSP if you're younger. If you're not special category, you're regular FERS. That's everyone else. That's most of the 2 million employees are regular FERS. You have a different age category. You have to make it to the year that you turn 55 or later. So many of you know that your MRA is 56 or 57. You don't have to make it to your MRA. You just have to make it to one day in the year you turn 55. If you do and you separate from the government, then you can get your TSP money penalty free. You don't have to pay the extra 10%. Still have to pay taxes on it. It's always taxable under the traditional side, but you don't have to pay the extra 10%. Okay? Since most of you regular FERS are going to retire when you're 56 or 57 or later, you automatically meet the threshold of the one day in the year you turn 55. Okay? So in essence, a way to simplify that whole long drawn out thing I just said is that if you are eligible to retire, whether you're special category or regular FERS, then you're also eligible to pull your money out from TSP without paying the early withdrawal penalty. Okay? If you transfer it to an IRA, you have to wait until you're 59 and a half to not pay the 10% penalty. There are some really confusing, complex concepts that allow you to get around those rules, but it's far beyond the scope of what we're talking about here. As a general rule, you can't pull your money from your IRA before 59 and a half. You can from your TSP. So if you retire and you're younger than 59 and a half, the TSP has a pretty good advantage. You can get your money quicker and cheaper. All right, so under 59 and a half, TSP has one big advantage. After 59 and a half, you can pull from the IRA just like you can pull from the TSP. The TSP loses its advantage, okay? So you'll see more and more people as they get older, seems to be, based on official statistics, that they're moving their money to the IRA, okay? Prior to 59 and a half, there's a lot of people that are going to leave money inside the TSP so that they can withdraw. They may still transfer some out. I transferred a bunch out to an IRA, but I did leave a bunch in TSP in case I wanted it, okay? I'll pause for a second and look at some of these and just make sure that, let's see, some of these questions. Okay. All right, so I did answer some of those. Some of these I'll get to later because I want to stay on track with what we're talking about. Can I provide an equivalent fund in Schwab or Fidelity or Vanguard that is comparable to the C fund? Yeah. In Schwab, the ticker symbol would be SWPPX. The Vanguard and the Fidelity ones are escaping me right now. VFAIX, I think, is one. Basically, what you're looking for is any S&P 500 index. Every company's got one. It's the most popular fund out there. So that is the same thing as the C fund. Oh yeah, somebody put this, Vanguard, VFAIX. Okay, yep. All right, so let's continue. That's why somebody would do that rollover. Now let's talk about exactly how do you do it. This is a little bit antiquated. We're in 2024. It would be better than this, but I'm going to explain to you exactly in boring detail how it works. Once you retire, you leave the government, or if you're still working after 59 and a half, this is actually available to you as well. But the first thing that you would do is you would go to your destination brokerage firm, wherever you want that money to end up. So if it's Schwab that you like, or Fidelity, or your brother-in-law works for Raymond James and he's going to handle your money, whatever, you go to that firm and you open an IRA. You open an individual retirement arrangement or an account. You open that there. You don't have to put any money into it. It's fine. It's not like a bank account where you have to open it with a deposit. In most of these firms, you just open it. It's just there. And then once it's set up there, you'll have a routing number and an account number, just like you would anywhere else. So I did all mine at Schwab. Like I said, I've had it for years. So I set up my IRA, my destination, my target account, and I got my routing number and my account number. I take that, then I log into my TSP. By the way, setting up the account at one of these firms is easy, super easy. You can do it online in just a few minutes. Fill out some forms, give them some information, social security number, all that kind of stuff, done. Now you go over to the TSP. Now we're getting into the complicated part. The TSP, you'll pull up you'll log into your account. You'll pull up some options. You will first have to register, or I guess register is the best word. You'll have to register your Schwab account or whatever your destination account is. You'll have to put in that information, your account number and your routing number. Okay. This is very similar to if you set up bill pay in your checking account, you go in there and you put in your American Express account and the account number and you have it registered. So now you can send money, you can pay your bill electronically. That's essentially what we're doing inside the TSP. You go into TSP, you set that up in there, and now that account is eligible to send money to transfer money to. Okay. Here's the first hurdle. I don't understand why this is. TSP doesn't explain it. As far as I know, they don't even address it. I can't find any literature on it. But you have to register that account, and then you have to wait for 7 days. You can't transfer money for 7 days. When I first did this, I was not aware of it. I tried to transfer immediately, and I was denied. And they said you have to wait 7 days. They didn't give me a reason. But this is standard practice across the board. So when you register your IRA account with TSP, you now have to wait 7 days. There's nothing you can do. So you go on and you live your best life, as the kids say, for 7 days. And then you come back and now you can start moving money from your TSP over to your IRA. You go into the withdrawals and rollovers tab. There's a tab there for pulling money out. And you follow the prompts and you put in whatever it is you want to put in. So last year I moved 700,000 over to an IRA. So I put in 700,000, went through all the things, had to go through my wife, right? They had to send her an email. She had to approve it. Then it came back to TSP and was approved. And then here is the staggering part. TSP is apparently very averse to 21st century technology or 20th century technology or 19th century technology. TSP will not move any money ever using anything that's been available for the last 50 years They will go back to the 1800s technology and they will use a paper check. They will cut a check. In my case, they cut a $700,000 check and they didn't send it UPS or FedEx or even certified. They put it in regular first class mail. So you get your $700,000 or your $2 million or whatever it is that you have in your account you want to transfer. You throw it in an envelope, they put a stamp on it, and then they send it off into the Postal Service, okay? And it's bouncing around the Postal Service for a week or so until it lands at this P.O. box in Florida for Charles Schwab. And thankfully, my check got there and it got deposited, and now I have money in my IRA, okay? There are plenty of stories out there of people losing their checks in the mail or their checks getting stolen in the mail. I know of two cases right now. One's postal, one's Secret Service, of checks that were stolen, TSP checks that were stolen out of the mail. That's obviously a long drawn out process if that happens to you. So in 2024, it blows my mind that we have Venmo and Cash App and PayPal and ACH we've had for decades, wires, all that stuff. They don't use any of that. Everything is a check. That is just ridiculous to me. But that's part of the antiquated, clunky system that is the TSP. There is an option when you go to pull your money out, when you make that rollover. The money can come to you first. That's sort of called an indirect rollover or an indirect transfer. In other words, it's not going directly from TSP to an IRA. It's coming to you and then to them. So that's indirectly. Don't do that. You don't want to do that. That complicates things for tax purposes. There's all kinds of issues. What you want to do is a direct transfer, directly from the TSP, directly to the IRA. That is not a taxable event. There is no tax generated on that. You can move $1 million over. It's not taxable because you didn't get the money. It didn't come to your bank account. It's not a withdrawal. You guys use that term a lot when you talk to me. You say, I want to withdraw money to an IRA. I understand what you're saying. You're pulling it out of TSP, but that's not a withdrawal. It's a transfer or a rollover. The withdrawal is when it actually comes to your bank account that you're going to spend it. Then it's going to be taxable. But if you're just transferring it from one retirement account to another retirement account, you haven't actually withdrawn the money, even though it's actually come out of TSP. It's not a withdrawal, okay? It's a transfer. So the terminology sounds a little bit like we're being strict about it, but that's how it works for tax purposes. All right, so that money goes across there. It's in there. You can do whatever you want. We can buy and sell. There's no tax on it until you make the withdrawal. Let's say you want to put money back into the TSP. So this is where a lot of people had questions on this. They sent it to me. What if I want to take money from the IRA and move it back into the TSP? First of all, you are allowed to do that. That surprises people for some reason, that once the money comes out of TSP, they think it can never go back. You can transfer it back into the TSP. The process is a little bit more clunky than the other way because it involves you working with both your brokerage account and the TSP people. And the brokerage account people are not really going to understand exactly what you're talking about with TSP because TSP has some very specific ways they want things done, not surprisingly. So what most people do is they call the TSP, they get a representative on the phone, and then they say, look, I want to transfer money from my IRA at Schwab to TSP. TSP will then do a conference call with a customer service rep at Schwab. Schwab has some paperwork they want you to fill out. TSP is going to tell Schwab exactly what forms they need, how it needs to be done. They're going to send that form to you. You're going to sign it. You're going to send it to TSP. They're going to approve it. It's going to go to Schwab. And then TSP demands that a check be mailed to them. So again, Schwab is going to have to cut a check. It's going to have to be mailed to a lockbox and then from the lockbox it goes to the TSP. It's unnecessarily complicated. But the bottom line is if you're interested in doing this, if you want to move your money from your IRA or some back to the TSP, then you call TSP. They will walk you through it with a representative from your brokerage account. If you've got your own financial advisor, you just do a conference call with them. They'll walk you through it. They'll tell you exactly the forms that you're going to need. The forms are going to differ from each brokerage account, so it's kind of hard for me to just universally say what that's going to be. But basically, you'll call TSP. They'll work it out with your broker, and the money will be transferred back. There's no penalty for this. There's no tax. Again, you're just transferring it back and forth. You can do this. So when people think about this, they're like, well, why in the world would I ever want to go back from an IRA to the TSP? Well, what if you transferred a bunch of your money out and you're only 56 and now you want a bunch of money, you want to make a big withdrawal to pay off a house or whatever you want to do, and you want to move that money, you want to get it, you don't want to pay the 10% penalty, so now you've got to transfer it first from the IRA back into the TSP and then make the withdrawal. Okay, hopefully that makes sense. It's a little bit complicated. Again, this is why I say by far the simplest thing is to leave the money in the TSP. May not be the best thing, but it is the simplest thing, at least until the TSP sets things up like the rest of the world's bank accounts where you can just transfer money. I have kids at college. I can just literally get on there and transfer money to their account with, in minutes. That's how the TSP should be. So when people are like, well, I'm going to transfer money back and forth from the IRA to the TSP, and then if I need money, I'll move it back and forth. Have you heard my explanation that I just gave? This is a pain in the butt. This is not something you're going to want to be doing every couple of weeks. It's probably going to take 2 weeks just for the transfer to happen in the first place. Okay, so I think this is basically a once a year, if that, type thing. I wouldn't recommend that you plan on transferring your money back and forth whenever you want. Okay, that's how the transfers work from the IRAs to the TSPs and back again. That is all. I do want to have one caveat. If everything that I just explained, the last 30 minutes or whatever I've been rambling on about, that applies to the traditional side. Okay, traditional TSP. The Roth TSP is a little bit different. If you transfer your Roth TSP to a Roth IRA, you can do that. You'll set up a Roth IRA first, transfer your Roth TSP to a Roth IRA. That is a one-way trip. That money is not coming back. TSP will not accept any Roth IRA rollovers. None. So if you transfer your money from the Roth TSP to a Roth IRA, it's gone. It's never coming back to the TSP. It can't. You can keep it in Roth forever. You can move it around to other Roth IRAs, but it's not coming back into the Roth TSP. All right. Another caveat is, and this is very important for those of you that are retiring soon and you're trying to come up with a TSP plan. If your TSP account ever gets closed, you can never, ever, ever reopen it ever again. So your TSP needs a balance of $200 to remain open. If your balance falls below $200, TSP will close you out. You'll never be able to open it up again. So if you transfer, let's say I have $1 million in TSP, you transfer $1 million to your IRA because you've got this, hotshot broker that's going to make you all kinds of money. Then that guy goes to jail because he was fraudulent. And you're like, man, I don't like this. This scares me. I'm moving my $1 million back into the TSP. If they've closed you out, you're never getting back in TSP ever. All right. So that's a one-time thing. It's done. So I tell all of my clients who are thinking about doing this, keep a minimum of $1,000 in the TSP. You only need $200, but I like a cushion. It's only $1,000. Keep $1,000 in TSP. Keep it in the G fund so it never goes down. You have no risk of it dropping below 200. And now your TSP is open. In a worst case scenario down the road, you can transfer money back into it if you'd like to. You might say, Chris, why would I transfer? You just went on and on telling me about how great IRAs are compared to TSP. That's exactly how they are right now. What happens if the laws change 10, 15, 20 years from now? I have no idea what the future is going to be. What happens if there's a financial collapse in the private sector? I have no idea what the future is going to be. Why would I limit my options? 10 years from now, it may be a no-brainer that the best thing to do is keep your money in the TSP. Don't eliminate that option. Don't burn that bridge. Leave $1,000 in there. Again, it's only $1,000, and you'll have the ability down the road, if it becomes advantageous to move your money to TSP, you'll be able to do that. Okay? All right, that is the transfer. That answered like 50 of the questions that I got. Let me talk about Medicare briefly, and then I'll get to some of these other questions, okay? Medicare. First of all, it's Medicare, not Medicaid. Medicaid is low-income state programs. This is not what we're talking about. Medicare is the government's version of universal health care, like in Europe or whatever. Medicare starts at 65, not 62, 65. There are 4 parts to Medicare. I'm going to really oversimplify this. There are 4 parts: A, B, C, and D. Government's not super creative in their term. So A, B, C, and D. Part A is the big hospital stays. Like you have a stroke, you're in ICU for weeks. You know how it is, you go to the hospital, you're in the hospital for 12 days and the bill's $95 million, That's part A. That's what it covers, hospital stays, those gigantic things. Okay. Part B is more routine doctor visits. Like, you're feeling sick, you go to the doctor. You hurt your leg and they give you a boot or something, like some kind of durable medical equipment, a cane or something like that. That's part B. That's what Medicare Part B covers. Those two together are what's called original Medicare. That was when Medicare started. That's what, that was the parts of it, the core. Part C is sometimes called Medicare Advantage plans. If you watch certain TV, certain hours of the day, you will see in between the commercials for reverse mortgages and Ozempic, you're going to see like Medicare Advantage plans. These are like private companies that are selling you insurance for people that don't have insurance. And they're getting like a combination of private insurance and Medicare. So Part C is like a combination of private insurance and A and B. Okay. And then Part D is prescription drugs. So that would be a prescription drug plan. So you could get that. That's the 4 parts of Medicare. Here's why most of Medicare you don't have to worry about. Part C, well, let's start at the top. Part A, it's free. It doesn't cost anything. You'll sign up for that. Why not? Part B, hold on a second. Shelve that. Part C, you don't need. You've got FEHB. Most of you listening to me have FEHB, our Federal Employees Health Benefits. You have that. That is insurance. Part C is for people that don't have insurance. You've got insurance already. You don't need Part C. Part D, prescription drug. All of FEHB plans have prescription drug plans attached to them. You don't need Part D. Okay? So A is free. You're going to get it. C, you don't need. D, you don't need. If they're irrelevant, you're not even going to think about those. B is the question. To be or not to be. That's the question. Do you choose B? B is not free. It costs money. It costs anywhere from $170 to $500 a month, depending on how much money you make. There's this weird concept. The more that you make, the more you have to pay in Medicare. Remember, A is free. So Part B is not free. And the question is, do you sign up for it? Why would somebody sign up for it? Well, number one, you do not have to. There is no requirement. There's a lot of beliefs out there. People email me all the time. I was told in a retirement seminar, I'm required to sign up for Medicare. You are not. FEHB does not require you to sign up for Medicare. If you are a postal employee, a postal retiree, unfortunately, they just passed a law. You guys are required to sign up for Medicare moving forward. You're required to. The rest of us, at least for now, are not required to. So you have the option to just blow Medicare off and stay with FEHB, or get it in addition to your FEHB. Most people I talk to do not get it instead of FEHB. Most people keep their FEHB forever. It's just good. All right. So we'll just leave it with that. But you can get Medicare to supplement your FEHB. Is it worth it? It's up to you. What if you say, you know what? I don't know that I'm going to get it at 65. I don't know if it's worth it. I'll wait until I'm 70 or 75 to get it. Here's the problem with that. The government requires, if you never sign up for Medicare, you're fine. If you never sign up for Part B, no issues whatsoever. But if you don't sign up at 65 and then you sign up later in the future, you're going to have to pay a penalty for signing up late. And it's a permanent penalty. Your cost has been jacked up for the rest of your life. For as long as you live, you're going to have to pay higher premiums on your Medicare because you waited. In essence, what the government's doing is forcing you or incentivizing you to contribute to this Ponzi scheme so that it helps fund everyone else. Okay. So if you're going to sign up for Medicare, you're probably going to want to do it at 65, or if you're still working, you don't have to sign up until you quit working. But you're going to probably sign up for at 65 if you want it. Why would you pay the extra monthly expense? Because you're already paying your FEHB premiums. Well, this is what retirees tell me. I'm not eligible for Medicare, so I have no firsthand experience other than dealing with it with my parents. But with FEHB and Medicare, Medicare becomes primary. You go to the doctor, you go to the hospital, they're going to bill Medicare first. Whatever Medicare doesn't pay, then the bills get kicked over to FEHB. FEHB takes care of the rest. Every retiree that has used both of them has told me they've had no out-of-pocket expenses if they had both. They would have had out-of-pocket expenses if they had one or the other, just one or the other. Okay, so having both is perfectly fine. FEHB doesn't expire. It never expires. You can keep it forever. You can sign up for Medicare. Medicare is primary. FEHB becomes secondary. Yes, it's going to cost you money. Every month, it's going to cost you extra every month to have Medicare in addition to your FEHB premiums. Some FEHB plans will give you a little bit of a reimbursement to help you out if you sign up for Medicare, because they're not on the hook for everything anymore. Medicare is relieving them a little bit, so they'll pass a little bit of that savings on to you. But that's how that works. That's a gross oversimplification. And I just had somebody a couple weeks ago who is making a lot of money in their 60s, and if they sign up for Medicare with their Roth conversions that they did that jack up they're going to have to pay about $400 a month for Medicare. To them, that was not worth it. So they're rolling the dice and saying, I'm just going to skip Medicare and not pay for it. I'm just going to stick with FEHB. Okay, so it's going to be a case-by-case dependent thing. And again, some of you watching here or are, or watching in the future, this is going to be archived for people to watch later. You guys may be in your 30s or 40s, 50s. Even in your 50s, you're a decade or more away from Medicare. Who knows what it looks like 10 or 15 years from now? The whole landscape could change. That entire explanation I just gave could be completely irrelevant if they force all of us to get Medicare or they grossly change Medicare or whatever. Okay, so if you're in your mid 50s or younger, I probably wouldn't even give 2 seconds thought about Medicare yet. If you're getting into your 60s, then you're going to want to go to Medicare.gov. It's actually a pretty good website for being a government website. Lots of clear explanations on there. In your 50s and younger, don't even worry about it now. You've got plenty of other things to worry about. Don't worry about Medicare. All right. That covered the main questions that I got. So let me run through a bunch of these real quick, and we can start getting to some of your stuff too. Can you tell TSP which side to withdraw from in retirement. So I said you cannot pick which fund you want the money to come from, right? Like you can't sell just your C fund. However, some of you probably, let me know in the comments if you have a Roth TSP. All of you have a traditional TSP. A lot of you may have a Roth TSP. When it comes time to withdraw money, you can tell TSP if you want to withdraw your money from the traditional side or from the Roth side. Used to not be able to. New rules say that they allow you to do that, which is a really important thing, because one thing I neglected to mention earlier when I talked about the ages for when you're eligible to get your TSP without paying the early withdrawal penalty, everything that I talked about related to the traditional side. If you have a Roth TSP, I don't care if you're special category or regular FERS, doesn't matter. You still have to be 59 and a half and have had that Roth TSP open for 5 years in order for that withdrawal to be completely tax-free. You guys know the reason you have a Roth TSP is because you want the withdrawals to be tax-free. That's right, they will be, but you have to meet both of those tests. You have to meet those hurdles. One, you have to be 59 and a half. Two, you have to have your Roth opened for at least 5 years. Okay, so if you're 58 and you're still working and you open a Roth TSP right now and you retire next year, you cannot get that money without paying taxes unless you wait 5 years. Okay, so you can now tell TSP if you want your money from the traditional side or the Roth side. You can do that. And there's a reason why you probably want to wait till you're 59 and a half to pull money from the Roth side. Okay, but the question was, can you tell them which side you want it to come from? Yes, you can. Question number 2, when is the 10% early withdrawal? That is, I mentioned that is, prior to 59 and a half, unless you meet those requirements that we talked about. What is the C fund in the private sector? One of you already asked that and answered it. Okay, what happens if I have a TSP loan and I go into retirement? This is very common right now. Lots of people have TSP loans. These rules have changed recently as well, a little more flexible. If you have a TSP loan, you can, number one, do nothing. You don't have to do a thing in the world. Let's say you've got $10,000 left on your TSP loan. If you don't do anything at all, eventually TSP is going to, what they term, default you. Sounds really harsh, but it's no big deal. They're going to say, okay, you're not paying your loan. We're just going to say that $10,000 that you haven't paid back, we're just going to consider that a withdrawal. And you're going to get a 1099 at the end of the year for that $10,000, and you're going to have to pay taxes on it. It's just a withdrawal. So that's one thing that you can do, is absolutely nothing. Let it go into default. Doesn't go against your credit or anything like that. Don't worry about the term default. That just means that you've decided you don't want to pay it. It's your money, so it's not going to go against your credit or anything. You're just borrowing from yourself anyway. You're eligible for a withdrawal once you retire, so it doesn't matter. It's just basically turning your loan into a withdrawal. The other option that you have is that you can now continue to pay it in retirement. TSP will send you a big packet and they'll put you on a payment plan, and you can continue to pay your TSP loan monthly, even though you're not working for the government anymore. That didn't used to be an option, but it is an option now. All right. I was under the impression you could keep doing this until you paid the loan off. But just a couple of days ago, somebody sent me some information. TSP, they've been paying on their loan. They retired. They've been paying on their loan. Once the 1-year anniversary to that loan hit, they had a few $1,000s left to pay, but they were continuing to pay it. They never missed a payment. TSP declared them in default because they said it's been a year and they're not making them pay anymore, and they're issuing them a 1099. That is the first time I've heard of that. It seems to imply that you only have 1 year to pay off your loan. I looked in the literature. I could not find that mentioned in any way. So I don't know what's going on there. this is par for the course from TSP. They'll rule on something and you can't find any literature or rules supporting it. So I don't know if they're correct in what they're doing. This guy is seeking more information. Follow me on my newsletter and social media, and I'll report on it once I hear back. But I've never seen anything that says there's a 1 year requirement. But it seemed like there was in his case. It's the first one I've heard of. So bottom line is you can keep paying your loan or you can not pay it. It's up to you. What is the G fund in the private sector? The G fund is the only fund in the TSP that is not available in the private sector. Everything else, if you're in the S, the C, the I, the F, as in Frank, there is a corresponding private sector mutual index fund available for that. You can buy that. The G fund is unique to the TSP. They're specially created treasury bonds. Don't want to get too far into Finance 101, but it's an investment that's only available inside the TSP. It is essentially the government's version of a high yield savings account or a money market account, some sort of government bond fund. So if you're looking for something like that in the private sector at Schwab or Fidelity, you're basically looking for a high yield money market account, something that the G fund pays about 4.5%. You're looking for a savings account that pays 4.5%. That's the equivalent of the G fund, although it's not exactly, because it's not guaranteed by the government. The G fund is, but that's the equivalent. When is the required minimum distribution age? All right, so there is a concept in the government. You do not have to get your TSP money until a certain age. When you leave the government, it generally takes about 3 to 4 weeks for your agency to notify TSP and TSP to get around to doing whatever they're doing to turn your account on. Your withdrawals, generally, you can start withdrawing about a month after you leave the government. That's about the earliest that you can start making withdrawals. Okay, so about a month after you retire. You don't have to take the money out, though. You can put it off, but you can only put it off until a certain amount of time. If you are, this gets a little confusing. I wish the government would let me write the laws. So if you were born prior to 1960, so you were born in the late 50s, all right, your RMD, your required minimum distribution age, is age 73 now, meaning at 73, whether you want your TSP money or not, it doesn't matter. They're sending you a minimum amount. The IRS makes them do that. That's part of the law. Okay, so the required minimum distribution is a certain age. If you are already at your age, like you're already, if you're on here and you're 72 or whatever, you're already at that age. You're already required to make those distributions. However, if you were born in 1960, you're not there yet. So if you're born in prior to 1960, it's age 73. If you were born in 1960 or later, your age is 75. I'm sorry, that's confusing. Again, I didn't write it. That's the government. So for a lot of you that are on this, you're probably born after or at least in 1960 or later. It's going to be 75. That's your required minimum distribution age. So your bookends, your window for making withdrawals is about a month after you retire, all the way up until age 75. Any time in there, you can make your withdrawals. All right, at 75, whatever your TSP balance is, on the traditional side, you're going to have to start taking with required minimum distributions. It's based on your life expectancy. Somebody asked how much it is. It's based on your life expectancy. The first year, it's about 4%. That's what it's going to be. So if you had $1 million in there, the first year, it's about $40,000, something like that. A little bit less, actually. That only applies to the traditional side of the TSP, or to traditional IRAs for that matter, if you transfer money to an IRA. Roth TSPs and Roth IRAs, no required minimum distributions ever. That's a new rule too. No required minimum distribution. Doesn't matter how old you are, you never are forced to take the money out of your Roth TSP. So some of you out there never want to use your money. You hate RMDs. You hate the fact that you'll have to be forced to enjoy your money down the road. You don't like that concept. You want to die with the largest balance you can so somebody else enjoys it. If you like that, if that's your approach, the Roth TSP is your game. Does the RMD require spousal approval? No, that is one time that it doesn't require spousal approval because the IRS is forcing you to take the money. So they couldn't care less what your spouse thinks. Do I have to, this drives me nuts. Do I have to contribute to the traditional TSP in order to get the matching? I don't know where this rumor started, but I'd love to spend 10 minutes in a room with whoever started this because this eats up so much of my time. You can put 100% of your money, your contributions to the TSP into the Roth. If you're under 50, it's $23,000 this year. You can put $23,000 all into the Roth TSP. You will still get your 5% matching from the government. Okay? There is no requirement whatsoever to contribute to the traditional TSP in order to get the 5% matching. All right? The matching will go into the traditional. The 5% that the government puts in, they're going to put it on the traditional side. They're not allowed to put it into the Roth side yet. That might be changing soon. But you don't have to contribute money. Some people are like, well, I put 5% in traditional and then I put the rest in Roth because I really want to be in Roth. There's no requirement to do that. Put all your money in the Roth if you want. You're still going to get the matching. Doesn't matter. What should a young person do with the TSP? What's their strategy? Contribute as much as you can. Probably, I'm not going to give financial advice, but if I were starting in the government right now, I would be 100% in the C fund. If I came on the government at age 25, if I was coming on now and I was 25, I would be 100% in the C fund. I would be 100% Roth, and I would throw my password away for 20 years and come back and check it. Don't move your money around. You guys that move your money around have way less money than if you got locked out of your account for 20 years, I promise you. Is the growth of traditional or Roth taxed at withdrawal? So everything that you pull out of the traditional TSP is taxable. Everything. Your contributions and the growth. Because the money's never been taxed before. So it's not like you're only going to pay taxes just on the gains or anything like that. There is no capital gains. It's all ordinary income. You pull out $50,000 out of your traditional TSP, it's $50,000 of income. They don't care how much you put in, what that $50,000 was, that gains or was it it doesn't matter. It doesn't matter at all. It's all ordinary income. The Roth TSP, you pay no taxes, even on the gains, if you've met that two-pronged test that I talked about. You have to be 59.5 and have had the Roth TSP open for at least 5 years. Okay, so there would be no taxes on that. Traditional TSP, always taxed. Can we max out the TSP if we only work half the year? Yes. Like I said, this year, if you're less than 50, it's $23,000. That's your limit. If you're turning 50 or older, it's $30,500. You can put the full $30,500 in even if you're retiring in August. There is no maximum amount per pay period that you can contribute. So if you're retiring next June and you want to try to get all of your $30,000 or $31,000, whatever it will be next year, in there, assuming you can afford it, you can put it all in by June. There is no requirement to only put in a certain amount per pay period. Let's see, talked about Medicare already. All right, I got some more here. All right, so I got this question a bunch of times. Where does our retirement money come from? Can it run out like Social Security? We are $35 trillion in debt and all of the other things, 135% of GDP or whatever the number is today. Can the government run out of money? Well, let me let me give you the factual stuff first. Where is our retirement money coming from? This is money that we've paid in. Depending on when you were hired, everyone in here pays 0.8%, 1.3%, 3.1, 3.6, 4.4, or 4.9%. There's a whole range depending on when you were hired and what category you're in. You're paying in. Your pension's not free, okay? Your retirement check's not free. You're buying that. You're paying into that. That money goes into what is called the Civil Service Retirement and Disability Fund. That money is separate from, supposedly not available to the rest of the government. It gets invested into certain special treasuries, so the money grows, and that's where our money comes from. That's the factual part. The opinion is, can it run out of money, or can the government borrow from it? I can't answer it. I don't know. The government, in my opinion, does whatever it wants if it really wants to do something. So it's not supposed to. It's not something I really worry about. If the government runs out of retirement money, it's also run out of probably of salary, and we probably have a lot bigger problems. But that is part of being a government employee. If you are a government employee for 20 or 30 years and you're getting a government pension, I have made myself completely reliant upon the government. So that's the best I can answer that. Can we still contribute to a health savings account in retirement? All right. I don't have time. I wish I did. We could talk maybe I'll do another one of these just on the health savings account, the HSA. Best account in the government. I think it's better than the TSP. The money is never taxed. Some of you have FSAs, flexible spending accounts. They're okay. There's a lot of drawbacks to that. The HSA, it's like the FSA on steroids. There's no limit. You could build up a couple $100,000 in that. If you have no idea what I'm talking about, at the end, I'm going to give you a little tour of my website. I'm going to show you how to find some of these answers. The bottom line is, for those of you that know, like the people asking this question, HSAs, yes, you can keep them in retirement. You can contribute to them. I still contribute to my HSA every year. I max it out. It works the same in retirement. You take your deductions when you do your tax return, not every paycheck like when you were working. If that was complete Greek to you, you have no idea what I'm talking about, please go learn. You're missing out on something that is awesome. I realized I was stupid to continue to work past eligibility. Okay. I realized I was stupid to continue to work past eligibility when I realized I was working for a net pay of only about $2,000 a month. So this individual currently brings home $7,000 a month while he's working. In retirement, he's done his numbers. He's only going to bring home $2,000 less, or $5,000 a month. So in retirement, with his annuity and his supplement, he's only going to be about $2,000 a month short, or $24,000 a year short. This is extremely common. I have this discussion pretty much literally every day, at least 3 or 4 times a week for sure. People don't realize how little they need to make in retirement to make up for the shortfall. And they are working longer to, this is not a question, this is a person just stating that they came to this realization, which many, many people do. Like hundreds of people a year that I talk to come to this same realization. You don't need that much money. People that are eligible in most cases, not all, but in most cases, you are better off retiring as soon as you're eligible and getting another part-time job and making just as much money with a lot more freedom. Staying longer to increase your pension is not always the best thing mathematically. And that's what he's pointing out. I have lots of articles on my website explaining that math in detail. I don't want to spend a bunch of time on it tonight. Will I get a raise when I file for Social Security compared to my supplement? Yes. The Social Security, even if you file at 62, will be more than whatever your supplement is, regardless of when you got your supplement or how much it is. By the way, please, please, please stop calling the supplement the Social Security supplement. It has zero to do with Social Security. Nothing. The supplement is not a Social Security supplement. It comes from OPM. It doesn't in any way impact your Social Security. It's not from Social Security. It doesn't work like Social Security. None of it's tax-free. You can't defer it to make it grow if you take it, which you're automatically going to get it if you're eligible. It doesn't impact your Social Security in any way. So please, it's going to confuse you if you call it the Social Security supplement. It's not referred that in any official literature whatsoever. Okay, so don't call it a Social Security supplement. When do I receive a COLA in retirement? This is another confusing term that gets mixed. If you work in Chicago, you do not receive Chicago COLA. There is no such thing. It is Chicago locality pay. If you move from Dallas to San Francisco, you do not move from Dallas COLA to San Francisco COLA. There is no such thing. You move from Dallas locality pay to San Francisco locality pay. COLA, cost of living adjustments, is what retirees get. It's what I get. I get a COLA in January. You guys, if you're still working, you get raises. All right, so a raise is the January adjustment across the board for people that are still working. COLAs are the across the board adjustments in January for the people that are retired. And locality pay is where you work in the country. When do you get COLAs in retirement? Now we go back and diverge from those two groups. Regular FERS, you are first eligible for your COLAs at age 62. Special category, you're eligible for your COLAs whenever you retire. My wife retired at 49. She started getting COLAs the next year at 50. Okay, so special category, you don't wait. You get COLAs right away. Regular FERS, you retire at 57. Unfortunately, you're not going to get a COLA until 62. And then the person had a follow-up question. When I get my COLA at 62, do I get all the COLAs I missed out on since 57? No. Sorry, you're going to get the first COLA moving forward at that January after you're 62. Okay, so that's the first COLA that you're going to get. That is a huge disparity between the two groups. I don't like that. I think everybody should get COLAs immediately upon retirement because a COLA is tied to inflation. If you're regular FERS, you're no less susceptible to inflation than a law enforcement officer. It's not like when you go to Walmart, you're paying different prices for things. Everybody has the same, is influenced by inflation the same. So since COLA is supposed to combat inflation, everyone should get it. Unfortunately, you regular FERS, you don't get it until age 62. How do you locate a breakdown in retirement like your leave and earning statement? So what this person's asking is like, you get a pay stub every 2 weeks while you're working. What do you get in retirement? Nothing gets sent to you via email or via snail mail or anything, but you can log into your opm.gov account. Once you retire, everyone gets an opm.gov account. They become your HR once you leave the government, and everything is done through them. They are your HR. And so you'll have an account like a self-service. Many of you probably get paid through NFC or DFAS or something like that now. So NFC has the Employee Express, the self-service. DFAS, I think, has My Pay. You can go on there and you could do, different self-service things. You'll have the equivalent of that in opm.gov, online services. You'll be able to go on there and look at some limited things, change your tax withholding, some allotment, that kind of thing. Where would I invest a couple $100,000 if I received it now? If credit cards were paid off, my credit cards are paid off. I don't have any credit card debt. I don't pay interest. And retirement contributions were made. I guess they mean like retirement accounts are already funded. What would I do with it? I would probably look at, this is not financial advice, but you're just asking my opinion. I'd probably look at land and real estate. I have bought some land. I'm looking at some condos now to kind of diversify and invest in something like that. That's where I would look, assuming that everything else was funded that was more important. So my kids' colleges are taken care of. I have an emergency fund. I've got, private IRAs. I've got TSP, all that kind of stuff. After that, I would probably look at land, real estate, that sort of thing. TSP people could not give me an answer to this question. Can I open up a self-directed IRA, buy rental property with my TSP money, make the money in the IRA, and then transfer it back into the TSP? So yeah, no surprise that the TSP customer service rep, the poor girl you got on the phone to ask that question to, did not know it. That's very complicated. The short answer is yes, but there are a lot of hoops to jump through. We talked about setting up an IRA. There's a different type of IRA called self-directed IRA. Little bit more rules, a lot more rules actually to it, but it is a more advanced concept. You can actually transfer your TSP money to a self-directed IRA that you could then buy rental properties. You could buy like an apartment complex with. And then that money would go back into that self-directed IRA and nothing would be taxable until you eventually withdrew it. Okay, very complicated. Probably less than 1% of the people listening to this would be interested in it. And if you are interested in it, you will not be going this alone unless you're an idiot. Please hire a good team of CPAs, financial planners that will help you avoid all the pitfalls of this. But can you do it? Yes, you can do it. The income and the expenses have to all be within the IRA. You cannot use any of that money. Everything's got to be inside the self-directed IRA. And then you could roll that money back into the TSP at some point down the road if you wanted to. I frankly wouldn't get the logic behind doing all of that, but maybe you have a good reason for it. Okay. Let's see. According to my handy dandy Rolex Explorer 2, I've been prattling on for almost an hour and a half. Let me address some of your questions that are in here. What is my opinion on long-term care? Long-term care, if you don't know what that is a type of insurance that is for the typical, let's call it end-of-life scenario. So we think about a parent or grandparent that has Alzheimer's, dementia, they go into a nursing home. It's not a fixable rehab type deal. We're talking about this, they're not coming out. And some of those homes can be very expensive. You can buy insurance for that. It's called long-term care insurance. The government has a plan for that. You have a federal long-term care plan. That's what it's called. You can buy that. You can't currently buy it. It's currently suspended until December of this year. It's been will be suspended for 2 years by that time. The problem is the premiums. This insurance used to be a pretty good deal, I thought, when the premiums were under control. The premiums have skyrocketed. They cannot get these things under control. It's gotten to the point where the premiums are so high that I no longer feel like it's a fantastic deal. I'm not going to argue with you if you want it. I'm not going to try to talk you into it if you don't want it. I'm pretty neutral on it because it's so expensive now. It's almost getting to the point where I'm going to roll the dice. So I currently don't have it. If you're wanting my opinion, I'm not preaching against it. There are a whole bunch of financial planners that would tell you got to get this. Right now, you can't get it through the government anyway. So if you want long-term care, you've got to go out to the private sector and get it until it reopens in December. Then you have to qualify for it. It's not automatic. Some people do get denied for it. So you have to qualify, you have to pass some tests, all that kind of thing. I'm pretty neutral on it. In my personal experience, my family history, with parents and grandparents that have passed away, long-term care would have done nothing to assist in any of those situations. So I'm a little less sensitive to it. Some of you probably have some really bad experiences with a parent or a grandparent going into a nursing home and they were in there for years and maybe it bankrupted or came close to bankrupting your family and you're very concerned about that. those people are more likely to sign up for long-term care. So those are my thoughts. I really can't give advice one way or the other on it because I'm pretty neutral. I'm not a huge fan of the federal program right now. This is so awesome. Okay. Thoughts on the role of the G Fund after 59.5 as it relates to leaving TSP for another custodian. G Fund, like I said, is a high yield savings account. If you think about it like that, then it becomes a little simpler. If you want to replace it in the private sector, high yield savings account. Something that's going to be relatively stable and give you 4 or 5%. That's what the G Fund is doing. If I pass before my wife, is she able to access the TSP penalty-free prior to turning 59.5? Yes, she is. The TSP will set up what is called a beneficiary participant account, a BPA. It is a type of TSP account for the spouse of the federal employee. There are certain rules to that. One of the rules is that they are immune from the 10% early withdrawal penalty, so they can pull the money out if they would like. Tuning in as a spouse of a federal employee, I'm struggling to understand what I really need to know about his TSP in the event of a premature death. Are there some top guidelines or starting places? First thing to know is this is nothing to really stress about. If your husband or wife didn't say passes away, that's going to be far more concerning than the TSP. The TSP, like I just said, they're going to set up an account. You can leave that money in the TSP. You can deal with whatever's going on in your life. Set the TSP on the back burner. It's going to continue to grow just like it always has. Then you want to talk to a financial planner eventually about whether to just leave it in there or move it or how you want it invested or if you want to use some of it. Okay. Plenty of literature on the TSP website about that. Can I fund a donor advised fund directly from my TSP? I want to say no to that. I can't think of chapter and verse, but I'm almost certain that would be no, Michelle. Yeah, Michael's trying to get Hannah to tone down the planning for her premature death of her husband. Your webpage states we certainly don't recommend an annuity. To maximize your TSP, Duo, Pierce and Campbell are recommending G Fund transfer to their managed FIA. Thoughts? I am the last guy you want to talk to about an annuity. I am not an annuity fan. I don't like them. I mean, I'm the guy that wrote the article Why Annuities Suck. Okay, financial planners. We may have some financial planners on here. I don't know. I'm against them. I don't think that they provide anything for the average federal employee they can't do themselves at a cheaper rate. Don't have a ton of time to go into exactly what you already have. 2 annuities anyway. You have your first pension and you have Social Security. I don't think you need a third. I don't think you need to give your money over to an insurance company, your TSP, and then they give you back what they think you should have over the rest of your life. If you know for a fact you're going to outlive your life expectancy, you're going to live to be 120, go ahead and get an annuity. You'll beat the insurance company at their own game. But without going into a whole bunch of reasons why, I'm not a huge fan of them. Now, going over to have somebody manage your TSP is a little bit different. So there are all different types of managed accounts. What I talked about moving money over to an IRA, I didn't really get into managed or unmanaged accounts. You can do just about anything you want. There's any range of assistance that you can get. You can get no assistance. You can send your money over to Charles Schwab and not have a single money manager over there helping you to do anything. The other extreme is that you can send your money over to somebody and they control all of it. They have full authority to buy and sell different investments, stocks, bonds, mutual funds, whatever. They're trying to grow that money. You're having discussions with them monthly, quarterly, at least annually for sure, about what your strategy is, how you're doing. They're going to charge a lot of money for that, relatively speaking. They're going to charge, the industry standard is about 1%. Some will be a little bit lower, some will be a little bit higher. So if you had $1 million, they're going to charge you $10,000. That'd be 1% a year. So $10,000 a year for them to do that. If you just do it yourself, $1 million, in an index fund, you're probably going to pay about $500 a year. So it's $500 for you to manage it yourself, $10,000 for somebody else to manage it. That's not to say in any way that that's a ripoff. I'm not trying to disparage financial planners in any way. They may be way worth their $10,000 or even multiples of $10,000. You're going to get a lot for that. Hopefully you're getting a lot. You're going to have somebody that you can bounce ideas off of. They can manage your funds. You can manage it kind of co-partners with them, whatever. So I'm not opposed to that. But straight out annuities where you do an irrevocable contract, if you've taken all your money and you've given it to an insurance company and then you get hit by a bus next week and it all goes to the insurance company, they keep the rest of it, I'm against that. If you transfer some or all of your TSP balance to an IRA and you're retired Leo, can you pull money from the IRA without the 10% penalty like the TSP? No, unless you're 59 and a half. So remember that Leo exception doesn't follow you around to all your different accounts. That is a TSP exception. You cannot avoid the 10% penalty withdrawing from a rollover IRA. That's why you want to keep your TSP account open at least until you're 59 and a half. I would agree with that. All right, we talked about that. Vanguard equivalent. Okay, I'm regular first. Do you still accrue your usual benefits while on paid parental leave? For example, would I still accrue annual and sick leave for the? Yes, you would still accrue that. Do you know if the TSP has plans at long last to allow in-service conversions, i.e. traditional TSP to Roth TSP? Okay, we didn't really talk about Roth conversions. That is when you take traditional money, traditional TSP, or traditional IRA for that matter, any type of traditional retirement account, and convert it to Roth. All right, we're not talking about your Roth contributions. You can make Roth TSP contributions every pay period. You can put money into your Roth TSP. But this person is asking, can I take my traditional TSP money and convert it, move it over to the Roth side of my TSP? Can I do that? The TSP does not allow you to do that. They do not allow that in any way. As far as I know, there's nothing on the horizon to allow that. Some employer plans allow that. If you work for another company, they may allow you to do that. Convert some traditional over to Roth. You have to pay taxes on the conversion immediately. That becomes taxable income because remember, Roth is all after-tax money, so you got to pay taxes on it immediately. But in some employers, depending on who you work for, you're allowed to do that. The TSP does not allow that. And as far as I know, there's no plans to allow that. If you want to convert your traditional TSP money to a Roth IRA, it's a multi-step process. You're going to want to transfer your traditional TSP to a traditional IRA at Schwab or Fidelity, wherever. And then once you're there, you're going to work with your financial planner. This is one time you're going to want to have one, or your CPA or somebody to help you to determine how much, but you can make those conversions in that Schwab account. You'll go from a traditional IRA to a Roth IRA. It's going to have all kinds of tax implications. Again, that's not a do-it-yourself thing unless you've been studying this stuff for years and you're super comfortable. Even then, I'd want to have a second set of eyes to walk me through it. All right, what other questions we have, guys? What else we got? While we have before we leave, I want to give you guys some additional resources here. If you are not familiar, let me figure out how to do this. Stand by. Look at that. All right, we're on my website now. This is my website, barfieldfinancial.com. It is completely free for you guys. It's expensive for me, but it costs you guys nothing. You do not have to register for it. You don't have to join anything. There are no ads. I don't capture your data. This is literally a 100% open source resource for all of you Furzonians, retired or active, whatever. If you want to sign up for my newsletter, I mentioned it, just scroll down on the home page and enter any email address you want. assuming you have access to that email address. Don't spam other people. I don't sell your data. Don't put your real name in there. It's probably best these days. Everybody's watching. Put a fake name in there, whatever. But I'll send out an email roughly once a month with different points of interest and articles. Speaking of articles, I post them here roughly once a month. And you can go through this. And again, they're completely open and free. This is the one I did just a few weeks ago, how to make a TSP withdrawal if you're retired. I even did this with pictures. So even FBI agents would be able to understand this. I mean, that's how simple it is. So if you click on it, I recently pulled $50,000 out to buy Mrs. Barfield Financial a vehicle, and aren't I sweet? And then I give you exactly pictures, exactly step-by-step how to do it. All right. That's helpful, but I didn't realize the box that I opened when I did that, because now people want me to post pictures of everything, do a rollover with pictures, do a transfer back with pictures, do this and that, so I don't know. I guess I'm just going to start pulling out money left and right so you guys have pictures to follow. Other articles on here. High 3, what is that? We hear about the high 3. What exactly does that mean? What exactly is included? You can look on that. Your lump sum annual leave payout. How exactly is it paid out? Barbell strategy. I got a bunch of questions on that. We don't have time to talk about that. Maybe we'll do another one. Maybe. You guys, please let me know. Give me feedback. Like seriously, if this was miserable, we still got a couple hundred people, so maybe it wasn't that miserable. But you guys put in the comments what you like. Should I keep doing it? This is for you. I already know this information. I'm not making a dime out of this. This is for you. So if you guys like it, again, like I said, this is kind of my mission, my calling in retirement. This is what I do, helping you guys. So if you want that, put it in the comments, what you want me to talk about. You know what I'll do? I got these world famous Barfield Financial coffee mugs. I'll pick 1 or 2 people out of the comments, and if you enter a comment, you'll automatically entered. I'll pick a few and send you some mugs. Okay, that's an incentive. I know you're a federal employee; you got to be bribed to do any type of work whatsoever. I was there; I get it. So do that for me. We will probably do some videos on the barbell strategy. Here's the raise versus COLA versus locality, the biweekly pay cap. No one asked a question about that. I'm surprised. I get a lot of questions on the biweekly pay cap. This explains it in great detail. Okay. So that is available to you. Articles. Look at these resources. This is amazing. You can write down here in the bottom right. I did not come up with these spreadsheets. A retired Secret Service agent named John came up with these spreadsheets. And what you can do, they're completely free, open, you download them. There's one for special category, one for regular FERS. You can run your numbers. HR not getting back to you about your retirement estimates, forget about them. Go in here, input your own numbers, run your own numbers, your own estimates to your heart content. You want to see what it's like to retire, how much you're going to get if you retire in June versus next June? Run the 2 scenarios. Change it up. Do it. Spend all day on it if you want to. Completely free and open. Some tax and retirement guides, a bunch of OPM links, retirement forms packet. This is the application for FERS retirement, the SF3107. This is what you're all looking forward to one day. Hopefully you can go on there and see what that entails. It's not that difficult. Some people freak out about it. It's basically, my website is a one-stop shop for you, or one-stop shop for you guys. Whatever I can do to help you guys. It's free. There's some links to Dan Jameson. Tammy Flanagan, please follow her. By the way, I didn't get on my soapbox. I did a good job. Please be careful asking these complete anonymous dingbats on Facebook how to invest your life savings. Okay, go to people that are reputable. Tammy Flanagan writes an article every week for GovExec, one of the best people out there for information. All right, to a certain extent, Dan Jameson is great too. Dan's got a couple of books. Hold on. If you're only going to invest $20 in your retirement, this is where you're going to do it. FERS guide. Let me put this on the big screen. The FERS guides books available on Amazon. You've got one for special category. You've got a red one for regular. Go to Amazon, Dan Jameson, get these books. They're $20 each for the price of a lunch. You're going to know more than 90% of HR people out there. Okay, really good stuff. Dan and I both are standing on the shoulders of Tammy Flanagan. She's amazing. She's been doing this for years. Follow people like her. Don't go on a TSP Facebook page and ask people, complete strangers, where you should put your life savings. And they're like, well, 80% I right now. And you don't even know who these people are. It blows my mind. I used to be on a lot of those sites just to kind of correct people because like 40% of it's wrong. And I hated that people were being led down a wrong path, but it was just too much. It's just overwhelming. So don't go to that. Go to places like Dan, my website, Tammy, go to opm.gov, go to the source, find the real information. Don't just believe a bunch of random rumors that you hear all the time. All right, I see the chat's going nuts. Let me see what we got here. Let's see. Wow, there's a bunch that came on here. Wow, I don't know if I'm gonna be able to get to all these. If you transfer, how many times can you move money from TSP to a new account like Schwab? There's no limit. From a practical standpoint, like I said, it's an absolute pain in the butt. And you're rolling the dice every time a check goes in the mail. So from a practical standpoint, once a year, if that, but there is no limit. Like you're not limited to the number. Can you transfer TSP to traditional IRA? And if you want to roll over into a Roth, are you subject to the 20% federal tax hit? Well, you're going to have to pay taxes on the withdrawal because the conversion is technically a withdrawal. You're going to have to pay tax. All that's considered income. So you're going to have to pay that tax. You're not going to have to pay it out of the money that you transfer. So I'm not going to automatically deduct 20% from it, but you're going to have to come up with that tax yourself. So you're going to have to pay all of that in the same year. I think that answers your question. Have you ever tried depositing money back into the TSP just for the experience? No. No. The only reason I would do it is just to explain to you guys exactly what it's like. And I have had dozens of people explain it to me that have moved money from Schwab to TSP. So I know exactly what the procedure is. So I would not do it just for the, hey, John's on here. Thanks, John. Sorry, I pronounced your name, but we love what you do. Thanks, man. I do really need to know how to pronounce your name properly. So I know I'm going to mess it up, so I don't try. Is there a limit to how much you can roll back into your TSP from your IRA? No. You can roll over multiple IRAs into your TSP. That's true right now. If you've got an traditional IRA out there somewhere, you can roll that into your TSP, even if you've never rolled money out of your TSP. TSP would love to have all of your IRAs. Will I make this available on the channel? Yeah, this will stay on the channel. This is going to be archived and will stay on there. No way to avoid paper checks. No, there is no way. Somebody else is, verifying that. I just did this a few weeks ago. I was checking Fidelity every day once TSP told me they cut a check. Yeah, it's a nerve-wracking thing to have a 6 or 7 figure check going through the mail. TSP rollover into an IRA or private employer 401k. Will I have to sell my CNS funds into the G fund before the rollover transaction? No, you don't have to do that. It seems like you would, right? But you don't have to. What they will do is treat it like a withdrawal, and so they will roll it over proportionately. So if you're 70% C and 30% S, that rollover is also going to be 70% C and 30% S. You can't control that. It's like a withdrawal. Oh, somebody answered that question right after you asked it. Maybe I should read a couple of these down before I answer. Are there any advantages to keeping a TSP account in order to have access to the G fund after age 59 and a half? Yeah, my opinion is you never close the TSP. You always keep that option. That was that whole thing that I said about the $1,000. Keep a minimum of $1,000 in there just to keep it open. Um, just because we don't know what the future holds. Right now, I don't see much of an advantage, but that does not mean that there won't be a huge advantage 10 years from now. As I heard it, under 59 and a half, be concerned about TSP. Don't think about Medicare. Over 59 and a half, get out of the TSP, except for the last focus on Medicare decision. Mike, that's a good summary, although I wouldn't just encourage everyone to get out of TSP. There are a lot of people that don't want to mess with all of that hassle, and they're going to stay in a C fund and a G fund anyway. So the TSP is perfectly sufficient for them. So I don't want to act like you're an idiot or you're a fool if you stay in TSP, or that everyone needs to get out. It is the simplest thing. And if you're not going to take advantage of some of those other things, maybe the TSP is sufficient. Can you not touch the Roth TSP until you have completed your traditional account? No, you can ask for the money to come from your Roth, even if you haven't done your TSP, even if you haven't exhausted your TSP account. You can tell them. Chris, thank you for years of information and advice. Your coin wall and logo look fantastic. Well, thank you. The coins I had nothing to do with other than going to the mailbox. You guys have done that. So, and some of these are super special. I'm going to have to shoot a video of the wall and talk about some of these coins, because some of them are really like super unique things with cool stories behind them. Would you say taking a residential loan from your TSP while still in service is a bad idea? Unlike a lot of financial people, I am not 100% against TSP loans. I think they have to be used in a smart way. I would never recommend taking out a TSP loan to go buy your Harley. But I have seen TSP loans be used judiciously and have helped the individuals. Like, one person I'm thinking of that comes to mind is they had a lot of student loan and car debt and credit card debt. They were young. They took out a TSP loan. They paid all that stuff out. This is when loans were like 1%. They paid off high interest loans. They paid it off right away. They never got back into debt. All that interest went to them. They saved themselves thousands of dollars, and it was good. I've also seen people take out multiple loans to buy frivolous junk. So a residential loan I would not be opposed to. Just make sure you understand the costs and the benefits. If you take out a loan, that money's not in there making you money, but that house may make you money. So if you're buying another asset that's appreciating, you may make up for that. But just understand the pros and cons. I'm not totally against it. During the tour of your website, can you please show us the link for the retirement Excel spreadsheet calculator? Yeah, John's amazing stuff is right down here under the resources page. He routinely updates them. John sends me an email, every time a little tiny bug is found somewhere in there. And so they're constantly up to date. I just uploaded the new ones a couple weeks ago. Literally, they're fantastic. I mean, thousands of people have used these. They're very accurate. He's been doing these things for free for years. He should be charging for them, but he doesn't. If I left my full balance in the TSP, would you utilize the G fund or the L income fund? I would use neither one of those. I would use a partial G and a partial C. Matter of fact, that's what I do. I make no bones about how I invest. I'm 70% C and 30% G. And I'm planning on keeping that forever. I don't care what the market does. I don't try to time the market. I couldn't care less. This is probably stuff for another time. I have this amazing opportunity where I talk to 2 to 3 TSP millionaires every single week. Literally every single week. I've talked to a couple this week already. I get an amazing insight into how they made their money. Some of them have 2 million. Some of them have 2.5 million. And it's just eye-opening. I wish every one of you had that same perspective. I need to do some videos on that, the stuff that they've told me. It will shock you. You think, oh, and these guys were great. They must have followed somebody. They must have timed the market. They must have made just the right moves. The highest balances always have the lowest amount of transfers. Most of them have 0 transfers over their entire career. 30 years in the C fund. One guy had retired $2.6 million, did not even look at his TSP balance for 12 years. He protected himself from himself. People that are out there constantly moving and timing it, we got an election coming up, we're going to move our money out because at elections XYZ happens. Those people never get to those balances. So I come up with a strategy. I'm a big fan of coming up with a strategy and sticking with it. Yeah, it depends on how risk averse you are. It depends on your risk tolerance, your time, your investment horizon, how old you are, all those kinds of things. We'll talk about that in another video. I've got a lot of articles on it on my website too. Somebody's marrying another Furzonian. Will they have to sign? Yeah, once you get married, you'll have to approve spousal consent for withdrawals. Do you have a checklist for pre-retirement, like downloading the electronic personnel file? I do, that I go over with my clients. I've never posted that. That's probably a good idea. I've never posted that on my website or anything, but I do have a series of notes that I go through when I'm doing these one-on-one with clients in the pre-retirement stuff. Mr. Big Dirty Dog says, thank you. Thank you. Great info. Okay, thank you. Some kind comments. Thank you, guys. If you have a parent that has a TSP, can you roll their money into your own TSP as their beneficiary? No, you cannot. Beneficiary, that you could do that only for a spouse. So if a spouse dies and that BPA is set up and the surviving spouse has a TSP account, that can roll that in there. But non-spouses, brothers, children, parents, cousins, whatever, friends, they cannot do that. It has to go into, the only thing you can do is roll it into a inherited IRA, which has its own series of rules. You got to take the money out within 10 years, a bunch of other stuff. Let's see. Is it, I'm considering opening up a Roth account. 55, 2 years left until I retire under special categories. You're going to go to mandatory. After retiring, I plan to transition a civilian job. If you're going to open a Roth, is it a good idea? It may or may not be. I'd have to dive in a little bit deeper. It's not a bad idea to open up a Roth. But if you're going to do one, I'd do one right away. Get that 5-year clock started. Okay, so here's a really good question. This is probably a longer answer. I'm going to try to shorten it. When you said, Kurt says, when you said in most cases, not all, it makes no sense to keep working past eligibility, can you touch on what a proper reason would be to continue working? One would be this. Let's say that you never, ever, ever want to work anywhere ever again. And you only have 1 year left to pay off your house. And you don't want to bother going and working somewhere else and starting at the bottom or starting a new job or whatever. Go ahead and work 1 more year, pay the house off, and then retire. So in that case, you'd be working past eligibility for a year. I can't think of a whole lot of other reasons. Maybe recovering from a divorce, but even then I'm going to say no, because you could recover faster if you retired and went and got another job. You could rebuild your TSP or your investment account more if you went and got another job. Bottom line, if you're worried about staying or going, use John's spreadsheets. See how short you are. He'll tell you how short you are. And you may find out you're only working for $20,000 or $30,000 a year, and you can make that up part-time. All right, so, find out. At least find out. If you're eligible, at least get an idea what you're working for. Understand the math. In my experience, 100% of the time, the more people understand the math, the more likely they are to leave sooner rather than later. People that don't understand retirement very well, they will generally go to mandatory, get an extension, 2, 3 extensions. This is your law enforcement. Regular FERS will continue to stay. Another reason that for regular FERS, if you're close to 62, you get an extra you get 1.1% when you retire at 62. Maybe you don't know that. But if you're regular FERS and you're close to 62, it might be worth staying a little bit longer to 62. Those are all long, drawn out. You come to one of my retirement seminars. You'll understand that. Let's see. Okay. What are the benefits, pitfalls of taking a lump sum payment from your TSP upon retirement? Okay, taxes. Number one is taxes. Taxes is everything. A lot of times people say, I only owe $300,000 left on my house. I want to pull $300,000 from TSP. You probably don't want to do that in 1 year. That's all taxable income from the traditional side. Talk to a CPA. Maybe you want to do $70,000 a year spread out over 3 years. That might be better from a tax standpoint. Let's see. Enjoy. Okay, so there's some encouragement in here. Okay. Let's see. We got 1 minute left. I'm going to end this at 2 hours. A lot of encouragement to please keep doing them. So I appreciate that. Anastasia says, Chris, thank you so much. You and Dan were personally responsible for me retiring at 50. I've always been grateful to you. That's very kind. Thank you. Dan's responsible for me retiring at 50. I retired within hours of becoming eligible. My wife retired the month that she was eligible, which was in January, by the way. She didn't wait till December to retire. That's a common thing. That's a topic for another day. Best time to retire. If there was any advantage to staying, trust me, I probably would have left anyway. But there's no way I would have let my wife leave if there was an advantage to staying. Trust me. If you already have an account, if you already have a Roth open, you can avoid the 5-year clock. This is from Mike Koonsman, a great, fine figure of a man. If you already have a Roth open, you can avoid the 5-year clock by rolling that into an account instead of opening a new Roth. So yeah, he's talking about Roth IRAs. There's a 5-year clock on a Roth IRA, but the IRS cut you a little bit of slack here. You only have to have any Roth IRA open for 5 years. So if you have 5 IRAs and they're all brand new, except you have one that was from 20 years ago, that 5-year clock is already met from that other one. It satisfies all the Roth IRAs. Okay. TSP still has a 5-year clock on its own, but he's talking about Roth IRAs. He's 100% correct. Yeah. Thank you, John, for the spreadsheets. Outstanding presentation. I recommend everyone have a one-on-one consultation with Chris. Information providing by Chris is eye-opening. Thank you. That's very kind. And Katie seconds that. Okay. 9 o'clock, guys. I will end it for tonight. There's a lot of information in the chat. I don't know. I think chat and regular comments are different. I'm kind of new at this thing. So I think everybody can see the chat comments in the future, but aren't there other comments too? Anyway, put your comments in. I will... I don't know, I guess plan on doing these if you guys want to see them in the future. And I will pick a couple out of the world famous Barfield Financial mugs. In the meantime, if you want to learn more about this, go to my website. I'm also on Facebook, Barfield Financial, Instagram, Barfield Financial, LinkedIn. Sometimes I post stuff on LinkedIn, whatever the medias of social that you like. Other than that, Michelle says, I'll answer one more. Michelle says, I was told not to pay my house off before retirement and keep it as an asset. Thoughts? Well, your house is an asset regardless of whether it's paid off or not. Less debt is generally better than more debt. I don't know exactly the reasoning behind it. Maybe if you have a mortgage that's 2% and you're making, 10% in the market, and that's where you would pull your money to pay your house off. Dave Ramsey wouldn't agree with that. He would say pay the house off anyway. I'm not going to go along with that. If your mortgage is 2% and you can make 10% on that money, I'm not in a huge hurry to pay that house off personally. Probably respected financial planners would say otherwise, and I'm not going to argue with them. Financial planners rarely we rarely agree on anything. So that's how that works. But you need the app to open to see the comments, just not the email link. Okay, thank you. Chris, please keep doing these. I always picture you as a haired individual. That's the way I like to picture myself, Mike. Do I look like I don't have hair? Maybe it's just the lighting in here is a little bit off. Maybe I need some better lighting. I actually have a full, luscious head of dark hair. So maybe it's just the poor lighting in here. Anyway, thank you guys. Enough of me rambling. You've wasted 2 hours of your life with me. Please follow me. Please share this with other people. Don't keep this stuff to yourself. The only reason I'm doing this is so the word gets out there. All right? It's the only reason. So help other people, especially the young people. Be the person that we wish we had when we were younger.